Hey guys, welcome back to the channel. I thought today we'd speak about a really relevant topic with everything that's happening with inflation at the moment, with US inflation at 7.1% and UK inflation at 10.7%, and how interest rates are going up with the US federal funds rate going up to 4.5% and the UK interest rate going up to 3.5%, and how this can affect our stock market investing, how also it actually affects the stock market as a whole. So I think the best place to start is by explaining what the Federal Reserve funds rate is, and I think we'll focus on the US here because it's probably the most relevant to everyone. So the Federal Reserve funds rate is the rate at which a bank can borrow money off the Federal Reserve. Now, when they increase this rate, this means it's more expensive for the bank to borrow money from the Federal Reserve. They then find that the bank will pass these costs on down to its customers in the sense of increasing interest rates on loans, mortgages, credit cards, etc. This then means that consumers don't have as much money to spend because they're spending more money on repayment of loans, etc. This then shrinks the money supply and in turn is used to try and reduce inflation and try to stop people from spending as much money. It also has the effect of affecting corporations because once their debt repayments become more expensive, they have less money to invest in like capital expenditure to grow the company, or to pay out in dividends, or to do share buybacks, and that way it actually affects the corporation itself and means that they can't grow as quickly. So you might be thinking, how does this affect the stock market and also my investing that I do? Well, besides the obvious, which I've sort of alluded to before, with the corporations having less money to spend on growth, this then obviously affects analyst opinions. It doesn't necessarily affect ours, but they might have come to a conclusion that the company's going to grow at a set rate, and within this conclusion they have to spend a certain amount on capital expenditures and their plans going forward. Now these companies might then have to change their plans and not grow quite as quickly, which in turn affects the growth rates that analysts are using in their projections to come up with an evaluation of their intrinsic value. And then that way the stock market has to reflect this by decreasing the price in the stock to obviously describe what the analysts are thinking. So that's one reason why the stocks will come down in price when inflation goes up and the interest rates go up as well. Now the second point of why interest rates affect the stock market is arguably the more important point, and that's that it affects the risk-free rate. It actually increases it because the risk-free rate is based off the 10-year bond that the Federal Reserve gives out, known as the T-bill, and this is known as the risk-free rate because the US has never defaulted on a debt, and if they did come into financial issues when going to repay this debt, they could simply print more money and repay that debt. So people class this as the risk-free rate, as it's the rate that they feel that they have no risk when investing into this product, that they are ever going to lose their capital. So when interest rates go up, so does the yield on these 10-year bonds, which are classed as the risk-free rate. Now, when these go up, it's more enticing and more desirable for an investor to put their money in this product instead of the stock market. Now, the stock market's seen as a riskier product, a riskier area to put an asset class to put your money in. Therefore, when the risk-free rate goes up, people require a certain gap between what bonds are yielding and what they require from the stock market, known as risk compensation. Because they're investing in something riskier, they expect to have a higher yield from this riskier asset to compensate for that risk to reward ratio. Now, when the risk-free rate goes up, obviously this gap between what they expect the stock market to achieve and what the risk-free rate is, they expect that to stay the same. So therefore, investors expect a higher yield from stocks than what they did previously. To get high yield from stocks, you need the price to come down, and this, tied with the fact that the corporations aren't going to grow as quickly, can bring the stock market down quite drastically to come in line with what analysts and what people that are investing in the stock market want to get out of these stocks. I.e., if they believe that a stock that is $100 is going to receive 10%, they think it's going to grow by 10% a year for the next 10 years, but then all of a sudden the growth rate comes down and the interest risk-free rate goes up from, let's say, I don't know, 0% to make the numbers easy, from 0% to 5%, well, they then need the stock to get that 10% gap. They need it to go up to 15%. And when it goes up to 15%, the stock's got to come down to reflect that growth, as well as the corporation isn't going to grow as quickly as they once thought. This then means that the stock comes down in line with this. I hope this makes sense, and I hope you understand what I'm trying to explain, but it is definitely important, and it's a factor that is going to affect our investing, but it's a factor that's non-controllable. There's two factors when coming to investing. There's important and knowable, and there's important and not knowable. We're never going to know what the stock market is going to do in reflection to interest rates. And also, we're not going to know what the Federal Reserve or the Bank of England are going to do in terms of interest rates. If people could predict 10 years out what interest rates are going to do, they would be billionaires. I think there's a famous saying by Peter Lynch that if an investor could predict interest rates 3 times correctly, they would be a billionaire. And there's not that many billionaires in the world. Therefore, not many people can predict the interest rate hikes. So it's a fact that is definitely important because it will affect our investments, but it's something that we're not going to know. So actually, we don't really need to worry about it. It's something that is just going to happen, and we're just unfortunately going to have to deal with it. But it's definitely important to understand how interest rates affect the stock market and why the stock market is reflecting by coming down or increasing due to the announcement of interest rates. Buffett has been very famous in comparing interest rates to gravity in the stock market, and this is exactly what it is like, which is what we spoke about previously. But he also says for a long-term investor, there's no need to try and predict interest rates, nor would you be able to predict interest rates. For a long-term investor, the most important thing you can do is invest in the company and make sure that company in the future is going to do better, because that's something we can try and predict more accurately by understanding the company than we can by purely guessing what the economy is going to do and what interest rates are going to do. Because even if you spoke to the Federal Reserve or the Bank of England, they don't know what the interest rates are going to be in the next year, because that's all down to inflation and how the economy reacts to everything. So there's no point trying to guess it if the people that are coming out with these interest rates themselves don't even know what they're going to do. Now, if you found this video helpful and it's helped you understand the current climate at the moment, please drop it a like as well as a comment, and please subscribe if you want to see more content like this, and I'll see you in the next one. Bye.